On this episode of Rein It In, episode number 66, we talk about how when times are good in real estate, you think they're going to go on forever. And when times are bad in real estate, you think they're going to go on forever. And on both accounts, you've been wrong. We also talk about Trump. We talk about Elon. We talk about AI. We talk about market dynamics. We talk about what's going on in real estate. And is Patrick selling his Edmonton portfolio? You're going to find out.
Like, subscribe, comment. How do you see what's going on in the world today? Politically, economically, let us know. We're going to talk about it. Let's rein it in. So JG, we hit a record number of people, of members looking at a video when we talked politics and we talked Carney. And it was like a record number of members opened the video. And then we get back into talking about real estate and the whole world just goes, wah, wah, wah. You guys are boring. It doesn't work. So I think we should open this particular segment and we need to talk about the dramas that are out there these days, the distractions that people seem to love. So let's talk about Diddy and let's talk about Elon and Trump. And let's see if we can get people's attention and they're going to listen to this video. So let's open, before we get to real estate, let's talk about the fight between Elon and the president of POTUS himself, Donald Trump. And then we can talk a little bit about Diddy. Not much, but I think we need to add it because that's what people are interested in.
Drama, drama, drama. Let's go.
Let's go. Okay, JG, I don't want to spend any time on it, but I think we have to talk a little bit about Trump and Elon. Is this a real fight or is this just optics to try and get more clicks and more views? I mean, Elon and Trump are just pissing in each other's cornflakes every single day. There's a tweet, there's a comment. Trump's been pretty quiet. He's been very professional. Elon's gone off the rails, which he's a genius and he's an eccentric genius. And he's the richest man in the world, eccentric genius. And it is interesting to see those two posturing. And I don't know that Elon's smart in terms of what he's doing, but then he brings to the table Starlink and he brings to the table the rockets and putting satellites and, building, the US defense system, the whatever they call that, the dome. And so Trump's in a tough place too. Who's he going to give that contract to? Given they've already put billions into what Elon's doing.
Maybe we should give it to Boeing and then people will end up in space again and people will be trapped in space forever. Who knows?
Well, listen, we know that if he gives it to Boeing, it's definitely going to go south. So, it's not. Elon has a track record. He likes to pull shit off.
Listen, here's what number one, I haven't been following it at all. I've been seeing a couple little snippets here and there, but yeah, the bros are pissed. The bros are fighting. It's not good. But here's what I'll say. The one thing I've appreciated about Elon from the very beginning is, and if you go back and if you track back, and I've done this, you go back to Elon in the 90s, this guy's always been the same. He's always, marched to the tune of his own drum. He doesn't care much about investors and all the stakeholders and corporate crap and politics is no different. He's always been very much the same. And it's interesting, so is this all put together? Shit, I don't know. I don't believe so, Patrick, but you probably wouldn't have to show me much evidence and I could probably be convinced. But let's just say right now, I don't believe this is kind of orchestrated. I think that this is, probably Elon just marching to the tune of his own drum. What is surprising is how quiet POTUS is being about the whole thing. And where's it going to go? I don't know. But I'll tell you this, if POTUS is quiet, it's only because he's building up something in the background. Because when he has that edge, he's going to come out swinging because that's what he does. You know what I mean? So it's very fascinating to watch.
Here's the thing. I think what happened is he goes in to do the program called, what was he doing? What was the
Doge
department?
Doge.
So he goes into Doge, he comes, he saves $1 trillion. They go to Senate, nothing happens. And so I think let's face it, we know that Elon moves fast. He's a business builder. He's got a track record for that. So he moves fast and he wants to get shit done and he knows how to manage costs. He's a business guy. And so he does all this work and then he goes in and realizes what politics is really all about. Now, Trump, very successful business guy, no doubt he's got an amazing track record, but he also knows politics a little bit more. So I think he's not saying anything because I really do believe at some level as two business guys, they align. I think where it goes off the rails is Trump knows how to play politics better now because he's been through the experience. And guess what? His first shot at the being president, everything kind of he learned his lesson, and so he comes in with a different agenda and a different way of doing it. And I think that this is all part of Trump maybe not being able to communicate with Musk and let Musk know what the thought process is. So he comes in with his big, beautiful bill or whatever they called it. And, which means, guess what? They're going to be printing more money, which we have to talk about. And we will talk about this whole printing money given the debt and the cost of servicing the debt. So in other words, the US doesn't even collect enough tax dollars right now, enough revenue to service the debt. And they keep creating debt. So I'll give you an example. This is US. And by the way, it's going to affect Canada. So bear with me here. So ultimately, for example, Trump shows up the other day, makes this big announcement. We're going to give all newborns $1,000 and, they're going to have that money to invest for the future. Where's that $1,000 coming from? They're printing more money. So what does that mean? It means that the dollar is going to continue to devalue. Over the past 80 years, it's already lost 99% of its value, its buying power. We've been through that before. What can you buy for $1 today or $1, let's say 50 years ago versus what you buy for $1 today? We know that the dollar's really gone down in value. So what is he doing? More debt, which means the devaluation of the dollar eventually, depends who you want to listen to, it's the collapse of fiat currency. And that's a whole different conversation. My point is inflation is going to come back in certain sectors, and we can count on it being in food and oil and gas, technology and all the rest of that. And of course, JG, we have to talk about AI and robots and the jobs that are literally disappearing right now today, not future state. I mean, future state's going to get worse. But right now, anybody who knows the industry in terms of AI and technology and robotics are going, there is not a job that can't be done by AI and robots. And that's going to happen way faster than people anticipate. So that probably scares the shit out of people.
I'm so glad you brought this up, Patrick. So we're gonna tie a little bow on the Trump Elon thing. We're gonna move into AI pretty quick here because that I think is going to have a meaningful impact. But I will say this though, and I think you touched on something important there, which is, in my opinion, Elon's been successful going against the grain and doing what he does and being ultra successful and genius. As we know, the man's a genius, at doing what he does and building the businesses he has and building the products and the engineering of his thought process and the engineering of his products. Incredible, off the charts, right? We know that. I mean, the guy can land a freaking rocket between two chopsticks. I mean, come on, who else can do that? So that's Elon. That's how Elon's been successful. And I think he continues to operate in that vein of he doesn't care who he's going to piss off. He's not attached to it. He's just moving in that direction. And for a while, Trump was on that bandwagon. Now Trump's not on that bandwagon anymore, and it's creating some friction. On the flip side, Trump's always been, and that's his genius, is he's been an amazing politician the whole time at how he raises capital and how he deploys that capital into real estate and all that stuff he's done for 50 years, and how he's parlayed it into politics has been incredible for him. And he's had a crazy run, as crazy as he is and all the crazy shit he does. I get all that. But the point is, he's still been successful. You can't take that away from him. And those two interests came together for a moment of time. And now those two interests are no longer aligned. And you got two extremely powerful people going in different directions now. So this will continue, in my opinion, until those interests realign again. Will they? I don't know. Time will tell. I mean, I can't foresee the future, but maybe they will, but maybe they won't as well. So that's a Trump and Elon saga.
Okay, but let's play this out and talk about Canada. So what's happening right now in the US is everybody's getting out of US bonds. So what's happening to bonds? Bond yields are going up because they have to figure, like, nobody wants US bonds. And by the way, let's talk about Canada. And our bond yields right now are kind of in that hovering around that 3% mark. But capital is leaving Canada. So this is all to say, as investors, I think we have to pay really close attention. And I actually think fixed rates are going to increase by the end of the year. And I think it could be quite dramatic I think bond yields are going to continue to tick up because we keep taking on more debt. People are not buying, like there isn't it isn't any money flowing into the bond market, not to the degree we need it. Our debt will increase. Our debt service will increase dramatically. And I think bond yields are going to have to go up in order to attract people into that bond market. That's what's going on. And people are seeking other ways to get a return. And bond yields, even if at 4% or 5%, by the way, when you look at the inflation, it's not attractive. So, and people aren't excited about what Canada's got going on. It's kind of messy.
And I kind of wanted to explain that, Patrick, because you and I, it's everyday business, but for the person who's maybe watching the show first time or multiple times, and we know we have a lot of avid viewers out there, Patrick. We got our raving fans out there. We know who you are, and thank you for watching.
We're up to it. We're up to at least a dozen.
At least a dozen raving fans. So thank you so much for watching. But for those of you that don't know how this works, it's actually pretty basic supply and demand. I mean, if money is not flowing into Canada and there's nobody to buy the bonds, they have to offer a higher rate in order for people to buy those bonds and to make them attractive. So that pushes up yields. That's what Patrick is talking about. So as a result, this makes the cost of capital more expensive for everybody because that's where mortgage rates come from.
It makes the cost of capital more expensive, including our government, which is going to borrow money to put into the bond market, and they're going to have to repay it. And so our debt service ratio from a country point of view goes through the roof. Like, it's just messed up. But it's all to say this, JG. Let's wrap this around real estate. I'm going to go back. We as investors need to get into hard assets because as we print money, as we devalue the dollar even further, we've been beating this drum for 3 or 4 years. The point of it is that we need to get into hard assets. Real estate is one of those hard assets. We talk about precious metals. We'll touch on that. And of course, Bitcoin. Those are options for you because, really, if you want to play in the stock market, that's a roll of the dice these days too.
Patrick, it's interesting. I want to, just because I'm in an explaining kind of mood today. It's probably because I haven't doing as much speaking engagements the last couple of weeks. So I feel like I need to explain stuff. But you talk about devaluation of the currency, and again, that's a foreign concept to most people. It took me a long time to wrap my head around what that actually meant, and I want to give people a real example of what it means. I went to the store yesterday. I was downtown Toronto for some meetings. I stayed overnight at the Weston Harbor Castle. Patrick, you and I stay there all the time. It's a great hotel. I go into the distillery district to get breakfast. I get this: 2 coffees, 2 sandwiches for my wife and I, a salad and a muesli. Okay. That's barely breakfast. Okay. 2 coffees, 2 sandwiches, a salad and a muesli, $72, my man. $72. I'm like, that right there is that's not the stuff. And this is what people have to understand. That's not stuff getting more expensive. And this has nothing to do with stuff getting more expensive. This has everything to do with the devaluation of the currency. That's what this has to do. And that's a very good example, Patrick, of the devaluation of the currency. $72 for barely breakfast.
Well, let's talk about it a little bit more. So yes, as you know, I enjoy a good hamburger. Like, I really enjoy a good hamburger. So if I go out anywhere for a meal, I'm looking at their burgers. So I have a pretty good handle on burgers these days. The least expensive burger with a salad is the least expensive I've come across in Alberta and British Columbia. Even Ontario actually was $23. And I went, wow, what a deal for a frickin' hamburger. And I'm thinking that's a great deal because they're literally most of them are $28 for a frickin' burger. And I have a salad. So,
and it wasn't that long ago, Patrick. Like, literally 5 years ago, you could have a burger and a pint of beer and a salad for $9.99 or $12.
Yeah, well, exactly. So like a burger was $17.95, $19.95, $14.95, and now boom, $28. It is really, it's just, yeah. And then of course the server's looking for a tip on top of that, 15, 20%. It's the cost. So here's the reason that this matters. Yes, devaluation of the dollar, things are going to continue to get more expensive, but here's what's happening. I gave my team a raise in Edmonton, and it doesn't matter. So my point is that I gave them 10%, and they're now looking at it, and we have really open conversations about it, and it doesn't even put them ahead. It keeps them, and they're well paid in that industry, like really well paid, and it does not keep them ahead of the game, and they know that. And so it's interesting that we look at that means disposable income. So what are they doing? They're paying their rent, or they're paying their mortgage. They're looking after their families to the best they can, but they don't have a lot of disposable income, discretionary, to spend on stuff. That, in a country that's really built around consumerism, really starts to slow the economy down even more. The exception to all this, Western Canada, by the way, or at least Alberta, Saskatchewan, Manitoba. I don't know where I'm going with that. All to say is life is getting more expensive.
Mr. Alberta, before we get into Alberta and doing all the things, let's talk AI. I've been dying to talk about this on this show for some time. I thought we'd do an entire show on it, but since you brought it up in this episode, let's talk about it. So where are we at from your perspective on all things AI? How are you using it? Let's talk about how we're using it, Patrick, and let's talk about the differences it's making in our particular business and the impacts it's having, not only for us, but what we think for the general market, and approximate timelines, because it was you and I talking about these kinds of technologies at summits that Real Estate Investment Network was doing in 2022, 2023, 2024. I mean, for a lot of people, this is brand new. Shit, you and I have been on this train for a while.
Well, we have, and that was one of the reasons was we had run into and read the book The Price of Tomorrow by Jeff Booth. That, for me, was one of the things that really opened up the door into what's going on and a different perspective of looking at what's happening economically. There is no question that if people are operating in an old story pre-2020, they're really going to get caught flat-footed. This is, since 2020, that whole thing changed everything globally, like everything. Central banks, how they operate, governments, how they operate. I mean, it changed everything. So when we look at AI and technology coming forward, now we have to acknowledge the speed of which it's happening is like off the charts. So we look at and we'll use, Elon's the easiest one to talk about because he's the most well-known, but the robotics and the AI involvement in robotics, I'll share that I was coming from Vancouver Airport out into the Fraser Valley. It's about an hour drive. We got a really cool driver in an Uber. He was in a Tesla, JG. He didn't touch the wheel for an hour, like virtually didn't touch the wheel.
Dude,
Do you know what we were
incredible.
doing in the car? Do you know what we were doing in the Uber? He's going, have you got a favorite playlist? Like literally we were playing tunes and singing with the Uber driver. It was hilarious. And he's like looking back, talking to us. It's like, but that car, and I was paying close attention to how it was dealing with traffic, going over bridges, around corners. Like I was really watching, and it was like, holy crap. Why does anybody want to drive anymore?
I've had the same experience, Patrick. My dad has an Uber, and he's got the full self-driving, and he's had it now for 2 years, and he's had full self-driving for 1 year, and me, I love to drive. I'm a Porsche guy. I love to drive. I like the thrill. I like it all. But man, it didn't take me 30 seconds, and I was like, this is incredible. Like for a road trip, I'm like, take me away. This is amazing. Go. And this thing is exceptional. I mean, it is absolutely exceptional. And yeah, so my dad with his Tesla, and sorry, I said he's got an Uber. He doesn't have an Uber. He's got a Tesla, which hopefully soon will be like an Uber making money for him. That'd be kind of cool. We'll talk about that next. But yeah, so it's fascinating. I totally agree with you, Patrick. But that's a world that's coming, and the self-driving vehicle is the ultimate kind of representation of AI, robotics, all in one. But this is having much more profound impacts in a variety of other industries, including your industry, Patrick, including my industry, right?
100%. So, that the whole thing is that technology is coming up. Let's talk about the impact of robotics. I mean, the robotics are, as you kind of follow along a little bit, as do I, you start to see just what they're capable of. I mean, right down to getting your hair cut. I mean, the robotics are now, I think within the next couple of years, you're just going to walk in, sit down, and your hair is going to get cut. Like it will literally do that. they're talking about within the next couple of years for 30 or 40 grand, whatever the number is, US, of course. But you're going to have a housekeeper that will do the laundry, do the dishes, vacuum your house. I mean, mow the lawn. So it's crazy. Well, I mean, even think about lawn mowing, the robotics around mowing your lawn now. It's
Yeah.
nuts.
I went to the John Deere store last Saturday. So funny story. I go take River, the dog, out for a walk in the morning. I'm about to do some work on the tractor. I put the tractor key in my pocket. I take River out for a walk through the farmers' fields, and all throughout I go probably 2-3 kilometers. I come back, go to start the tractor. I lost my key. Lost my key in the field. So I retrace my steps, can't find the key. So, anyways, if you guys want to find out, if you guys want a John Deere, just go look for my key. Anyways, but the point is I go to the John Deere store to buy a new key. And when I get there, they have a huge display. This is the John Deere store, huge display of automated robotic lawn cutters. They're looking into the future saying, listen, we're not going to sell John Deere machines forever to do lawn mowing anymore. We're going to sell these things. And it's amazing that, some companies are really getting ahead of this thing because they know if they don't, they're going to die.
100%. Okay, so
but I want to ask a question before we move on. I want to ask a question, Patrick, which is not of you, but of the viewers. Is like, I want to know from people, put in the comments, what kind of AI are you using? I can tell you, Patrick, myself, and I want to hear from people. Are you using ChatGPT? Are you using Gemini? Are you using Manus? Are you using, like, which applications are you using that are powered by AI? I'm curious because I know for me, Patrick, literally nowadays, it doesn't, probably 2-3 hours doesn't go by. I've touched AI several different times in several different apps. It's everywhere now throughout my organizations. And I tell my people, all my employees, I mean, Vistra, we just hired like 4 or 5 people in the last week, and we're immediately setting them up on AI. Like, if they tell us, we actually ask them a question in the interview, how they feel about AI. If they don't answer that question properly, if they're jittery about AI, if they don't believe in AI, if they don't think it can help them, they don't get hired, Patrick. Like, this is an AI first company. That's where we're at.
Well, you make a really great point, but I'll point out something is that we're using, or AI is being used, we're not even aware of it, but when we're going into and using whatever apps that we're using. So aside from the fact that we're intentionally going into some kind of an AI, whether it be ChatGPT or whatever other stuff is out there, the point is that in behind the scenes, AI is driving most of the apps that we're using also. So technically we're not driving the bus, but the AI is driving the bus in terms of the apps that we're using. So it's here to stay, and it's only going to grow. That's the end of it. To your point, like you, I mean, I do a lot of writing, I do a lot of research. I use ChatGPT, the paid version, and it saves me I countless hours in terms of what I'm doing in my writing and my research. So you got to use it. But interesting. Okay, so to your point, 2 questions when I'm in a live audience, whether it's 50, 100, 150 people are kind of common in terms of the audiences. I ask 2 questions. Show of hands, who's using AI? So if there's a room of 100, I would say maybe 20% put up their hand. Some people kind of put up a half a hand, right? And so I'm saying 20, 25% of our audiences are engaging in AI, which frightens me for them. I'm afraid for them because they are going to be chasing it and trying to figure stuff out. That's the first part. The next question I ask when we talk about devaluation of currency, the whole fiat meltdown, if you will, and I ask people, how many in the room own precious metals? Any gold bugs in the room? And do you know something? I did that in 2 audiences of over 100 people. 2 people put up their hand in both those audiences, totally different audiences. So I don't think, as much as we're in it every day, people don't understand what's happening with our currency and what that means to us as investors. So this goes back to the whole real estate world, which is, folks, we had, what is it? When the market's hot, everybody thinks it's going to last forever. And when the market sucks, everybody thinks it's going to last forever. And right now, everybody's sitting, not everybody, most are sitting on the sidelines waiting for, I don't know what, maybe for the market to get worse, to crash more. which will then really keep people on the sidelines when both you and I know that investors who are paying attention are going out and they're hunting for deals all the time in the world, right offers, low ball stuff, and there's all sorts of deals to be had. But rather than take advantage of the down market, everybody's into the herd mentality. The world's coming to an end. Real estate's going to crash and burn. I don't know what to say about all that.
Now, Patrick, I definitely want to touch on that. That's because that's really important. But I want to come back to what you were just saying about AI, because I'll put up an image on the screen here with regards to what we call the adoption curve, and we're definitely at the point where we're cresting beyond early adopters and we're getting into the early majority. But it's still very, very early, and a lot of people think like, "Oh man, I missed it. I missed the wave." You're still really early, guys. You're, like Patrick said, you're in the 20% ish range of adoption. So it's still very early. Now it will tip very quickly. And I think we're at that inflection point, or we're definitely getting close to that inflection point. So we're going to go from 20 to 80%, like really, really quick, like within a matter of months, not years and years and years. People think this is going to last a decade. The adoption is going to all happen in the next couple of years, but you're still very early. So if you haven't caught up on it, if you haven't looked into it, if you haven't done the research on it, it's not too late, because you're still in the early part of the adoption curve. You're still at the 20% mark, give or take. And I'm sure there's some stats to back this up. This is my own personal take on where I think we're at. And based on the kind of anecdotal surveys we've taken, Patrick, from the rooms we speak around, around the country. So it's not too late is my point for people.
Not even close to too late. This is early adoption, still part of the phase. It's still fairly early on. So anyways, okay, let's talk about some real estate. What's going on with real estate? We know that.
Well, I heard you sold a property, Patrick. I want to talk about that. Tell you, I heard you sold some property.
I got a couple, in the Edmonton market, which for me, given the property type, I want to get out of this market. I think there's an opportunity to do that, given that Edmonton is kind of still in that world of things are pretty hot, not quite as hot. Things are getting a little softer. Anyways, my timing seemed to be very good. I listed the property. I priced it right. It was a single family detached in the right part of town. I listed it on a Wednesday, and by Friday we had 4 offers. I took the one offer, which was out of the park, came in above asking, put 10% deposit down, no conditions. I went, oh, maybe I sold too cheap. No, I didn't. There's 4 offers. One guy pulled out. 3 offers were, one was for the asking, one was $5,000 less, one was $5,000 more, no conditions, and 10% down on the deposit. I went, that guy's serious. Let's get it done. And oh, by the way, 30 days and we're done.
That's amazing. Now, listen, so we're going to put on the screen some Edmonton monthly home sales numbers. We can speak to that, Patrick. But I got to say, bit of a contrarian there, Patrick. It was probably 3-4 years ago. You started telling people Alberta was the next hot thing. At the time, Alberta was not the hot thing. You called it right. Now everyone's a genius that moved into there. By the way, I took your advice. I started buying real estate in Alberta in general. Worked out phenomenal for me. ROI has been off the charts, which is great. But here we are. A lot of people think, hey, there's nowhere else real estate's working except for Edmonton and Alberta. And here you are selling property. Are you crazy? So tell us about this view. Get into it.
Okay, so first off, I'm still very bullish in Alberta overall. Let's shine a light on Calgary. 3.5 years ago, when we started to see that condo market in Calgary, I mean, I couldn't have said it any clearer. Stay the hell out of the condo market in Calgary. And of course, what we're seeing is the condo market in Calgary is getting really soft. I won't call it melting down. If you own condos and you were hoping to assign those deals like many were, of course, it's melting down. The point is that Calgary has finally kind of softened. The condo market's really soft. When I look at what Edmonton is, I know Edmonton follows Calgary's lead always. That's one indicator, by the way. But when I look at what's happening, I'll go back to what I've said all along. Edmonton makes me nervous. The tertiary markets, so get outside of Edmonton, Stony Plains, Spruce Grove, Fort Saskatchewan, Nisku, Leduc. I mean, even a little bit south, Sherwood Park, you can go a little bit out there. But my point is that Edmonton, I've said since 2020 is making me nervous. I do not like what they're doing with this whole 15-minute city scope. I have no listen, if they pull it off the way they say they're going to pull it off, it means they've already got 14 zones. They're already putting in the infrastructure, which means don't drive. And if you do drive, you're going to pay the price for it. Otherwise, you got to be on LRT, you got to be on a bus, you got to walk, you got to bike. And it's all about shrinking our carbon footprint. The problem is Edmonton's freaking broke. The city's broke. And we're going to see huge increases in property taxes. This is just my opinion. This is how I'm connecting the dots. So you can either agree with me or not agree with me. Many are in the Edmonton market. And guess what they're doing, JG? They're doing infills. They're knocking down old stuff, putting up 4-plexes, 6 and 8-plexes. Very common strategy. What's happening in Edmonton.
The zoning in Edmonton is phenomenal for that strategy. Edmonton's good for that.
Yep. So is Calgary.
The zoning policies are good for that.
Yeah, they get shit done really fast. And by the way, you're not paying 33% in terms of zoning and permits and all the bureaucracy that everybody else in BC and Ontario have to deal with.
But Patrick, I think I just want to connect the dots myself here, because this is exactly in line with that kind of the theme of how we open the show a little bit, which is when times are good, people think it's going to last forever. When times are bad, people think it's going to last forever. The point is that it was bad in Alberta for many years. You know what I mean? 2018, 2019, 2020, it was bad. And people were thinking like, this is going to go on forever. And you were like, hey guys, Alberta's looking pretty good. And you were going against the grain. Now, people are thinking, this is amazing. Alberta's going to be great forever. And Edmonton's going to be great forever. And again, you're going against the grain. So it's just interesting. I want people to pay attention to that a lot of people, the natural default for people, including you, including me, and just humans in general, is when times are good, we think it's going to last forever. And when times are bad, we think it's going to last forever. And we're wrong on both counts every single friggin' time.
Every single time. All I'm saying is that I believe Edmonton over the next 12 months is going to start to get noticeably softer. So let's, Jamie, make a note of that, and let's bring up the video. We should have made it.
Is that a Patrick prediction? Is that a Patrick prediction?
100%. Now, it's not going to, by the way, I'm not suggesting it's a bubble that's going to burst. I'm not suggesting that it's going to crash and burn. What I'm suggesting is...
I thought this was the drama show. We were doing drama. So I'd like a little bit more, bubble's going to burst. The market's going to crash.
No. It's not going to crash, but it's going to get softer. And I'm telling people right now, there's a lot of stuff that's happening in a global macro kind of point of view, the politics of Canada and all the stuff that Carney is going to do or not going to do. I think we just have to pay attention to it. So here's the thing. We need to own hard assets. Let's just connect the dot to that, given what's happening with the Canadian dollar, fiat currencies in general, global macro, lending, all interest rates, all of that stuff. So we're going to see the dollars lose value. We need to invest in hard assets. This is not the time. JG, you and I've talked about it on almost every episode. We've said this is not the time to over leverage. And what's happening is many in the multifamily world, because of the MLI Select program and commercial lending, because that's where it makes sense to go, what are they doing? 50-year amortizations, 5% down. And I'm saying, if you want to put 5% down, you do it, but you better have 15% in your bank account, because things are going to get soft and you're going to need that cash. So do not over leverage right now. That's it. Go hunt for deals, create opportunities, solve problems, make money. That's the beauty of this market. You don't have to over leverage because there's a ton of deals out there right now. And it's interesting, Patrick, back to this MLI Select program. You're 100% right, by the way. And I'm working on an MLI Select program deal right now with one of a sixplex that I'm building, talking to my energy consultant, which, by the way, MLI Select makes you hire this energy consultant. They charge you about like $7,000 or $8,000 to do energy modeling so that you qualify for the MLI Select. All part of the fees and the bullshit they charge. Oh, it just drives me crazy. Anyways, but this is not a drama show. Actually, this is a drama show. Let me continue. The point is that, this guy was telling me, I was talking to him, a great guy, by the way, but he was telling me, he's like, we were talking about our forecast and how much, I was planning to leave into the deal. And I was telling him, I said, oh yeah, like I plan on leaving, 20, 25% of the deal. I mean, if it's less than 25, it's a bonus for me. So, but I'm counting on 25% equity in the deal.
And he's like, oh, that's so great to hear. So many people I work with, they try to do it with less than 0% equity, meaning, oh yeah, I'll get 120% leverage on this thing. I'm like, that's crazy. He's like, that's what is attracting people to the MLI Select program, is they think they can do this for 0 down or 5% down. And he says, then they come to the end and exactly what you said happens, which is they get to the end, they got to pony up 50 grand, 100 grand, 200 grand, 300 grand, whatever the number is, doesn't matter. And they don't have it. And the whole thing gets washed out. And it's fascinating, Patrick. So this guy was telling me, like, yeah, most people are in that position. And I said, no, I'm ready to leave 25% of this deal. That just makes good real estate sense. And he's like, yeah, that's how most people aren't thinking like that. It's interesting.
We can't step over that. We are at the effect of what's going on in the global macro. And what doesn't get talked about mainstream media is what's going on in terms of what Ukraine and Russia are doing right now, Iran and the US are doing. The UK is melting down, Germany is shut down. There's a lot of global macro stuff that's happening. All to say this is not the time to curl up in the fetal position and wait for the world to come to an end. This is the time to get out, hunt deals, build a portfolio of hard assets, real estate being the primary one in our world. That's where we want to play. And we want to make sure that we're doing it thoughtfully and strategically and not just throwing money up against the wall to see what sticks. This is the time to be in the market. It's not seemingly as fun, but JG, look at what you are doing with Vistia and your teams. You guys got a ton of projects on the go. You're finding great deals. You're getting and seeing great upside. You're managing the rents. You're getting great cash flow because you're densifying. There's so many opportunities out there, yet so many are sitting on the sidelines. And I do want to say one thing, because I know people are listening going, yeah, well, I can't get financing. And there is a problem. There is harder work to get financing. So that there's no doubt about that.
By the way, Patrick, and if someone's watching this right now and they think that, yes, you're 100% right. It is more work than it's ever been, for sure. But it's not just for you. It's also for me. It's also for Patrick. It's for everybody. It doesn't matter how much equity, capital, money in the bank you're bringing to the table. The stuff, the hoops I got to jump through right now, Patrick, they are unbelievable. And some properties, I'm just buying them cash. I'm just saying, you know what? I'm going to ride this out. I'm just going to buy this cash. I'm going to let it ride. I'll refinance this shit in 2 years when things loosen up, because it is nuts, the stuff to make. But that's the game we got to play. And I'm actually doing. And so we've adjusted business strategy around that. That's what you got to do as a real estate investor. You adjust your strategy and your tactics around the market realities. And we've done exactly that. And using more cash is one approach. If you don't have access to that cash, another approach we've been doing is we've been doing a lot more active participation in the mortgage market that we used to just kind of like, it was a set it and forget it in the mortgage market. Now I'm having meetings every week with my mortgage brokers to see what the hell's going on in the market, where the opportunities are. So I have my ear to the market way closer than I ever have, because that's what the market is demanding from me right now. So that's what you got to do. We're real estate investors. We have to react to the market realities, and that's what we're doing. So the opportunities are out there. There's no doubt about it.
But let's talk about a couple things. So let's talk about Alberta right now and some of the concerns. So overleveraging is, in a hot market. Everybody seems to do it because they don't think this is ever going to end. And we know that it will end. It will slow down. And so here's the key. One of the things that you've always paid attention to is what's happening in the rental market. So if you're going into a deal today and you're saying, okay, well, based on the rent today, I'm cash flowing, I don't know, we'll just throw a number out there. Let's say it's $100 a month. I'm cash flowing $100 a month. I got this duplex. It's cash flowing $100 a month. That's awesome. Well, here's the thing. Will it cash flow if rents come down 5%? Well, then you got to do the math. What I'm suggesting in all of this is it's not the time to walk the line in Alberta, in Edmonton specifically, to think that the rents are going to be sustainable. The rents are going to get softer in Edmonton, for sure, over the next 12 months. There's just no way around it.
Why is that? Why is that, Patrick? Just a lot more supply hitting the market, less demand, combination of both?
Lots of rental demand, or lots of rental supply hitting the market. Like Toronto, The condo market in Edmonton has always been problematic. There's lots of condos to rent. There's lots of condos to buy. They're cheap. And, sadly, people are buying into it, and then they have no idea how they're going to exit. They have some story about how they're going to exit one day. I'm going, good luck in Edmonton. The point of it is that you better be doing the math on your cash flow, given that rents right now are pretty strong. They're finally getting softer. So anticipate rents coming down, especially in some property types, like standard condos. There's so much of that stuff in the market in Edmonton, and you're competing against it. And there's lots of new stuff. So this goes back to what I said before. So many people are building new. So if you're buying an old building, you better upgrade that thing right away, or you're going to be competing against new inventory.
Now, Patrick, now that we've covered the drama part of the show, let's talk about the housing market. Let's get to the housing market. Well, I guess if we're talking about Toronto first, there's quite a bit of drama going around in Toronto too. Not the good kind, but there is some drama, isn't there?
Well, it continues, right? That we know that the condo market and it's skewing the numbers. So the condo market in Toronto is full on meltdown. It continues to get worse. Foreclosures are going up. Power of sales are going up. Delinquencies are going up. This goes back to what we talked about a little bit, so people can connect the dots. The banks are on the hook for a lot of money. So there's a lot of lending that has gone on. And by the way, there's still some banks that are doing blanket appraisals back from when it was 2 years ago, so they can justify loans against properties that are upside down. That's the politics of it all. Fraud has been like off the charts in Toronto, GTA. And the point of it is that market is going to continue to get worse, but the banks are at the effect of that. So they're tightening up because they're going to manage their losses, which they're anticipating and already are starting to tick up dramatically. And over the next couple of years, you're going to see a lot of that happen more. And the banks are on the hook with full developments, by the way.
And these are big buildings. These are very, very big buildings. Power of sales, Patrick. These are monthly new listings that have the power of sale in the description. There's no category for this. Like, you can't search by just power of sale, but we get the AI to scrape for the description. So this has been on the rise quite a bit as well. I mean, these are monthly units, so it's not like I'd like to see this as a percentage of the market instead of just numbers. But the point is it's gone up. It's gone up significantly. Like, it's gone up 7 times since 2023. 7x.
Big growth. So, and we're just getting warmed up. I mean, people historically in Canada, they're pretty effective at making their mortgage payments. But this is, it all happened quite innocently. People started, 10 years ago, make $100,000, and then 5 years ago, make 200. Why don't we just double down? I made $100,000. Well, gosh, I made $100,000. I could buy 4 and then flip them, and I could make 400,000. So the next thing you know, people are like, no intentions. They're putting down payment. They can get in for $5,000 down, $10,000 down.
Yeah.
So anyways, here we are. So let's not talk about Toronto. That's a mess. Unemployment continues to tick up, and it will continue to tick up. So Ontario is going to, Ontario will, it depends who you want to talk to. They're already in a recession, and it's only getting worse. So there was some positive news around employment. That will be short-lived, but we're going to continue to see the unemployment, especially in that construction industry, which we've been talking about for over a year now. This is the thing around all of what we do, JG, is we see the future, we talk about it, but in a world of instant gratification, in a world of instant, what we're talking about doesn't come to fruition for a couple of years. So we're not right until 2 years down the road.
That's the beauty of this thing. It's like, listen, if you could, I know that you and I see it that way, and maybe not everybody does, but that's what I love about real estate. You can see the wave coming from so far away. You know where the market's going to be. It's very clear when you know what you're looking for, and you can get there before the market gets there. It's an incredible advantage to have. And well, I guess, Patrick, that's why we're geeks like this. We love the data.
Yeah, nobody listens to us. That's the problem, and that's why nobody listens to us, because we're. It sounds like
Let's
doom
talk.
and gloom, but it's like, no, this is a good time to come into the market.
Let's talk. Let's talk Vancouver, Patrick, in terms of where Vancouver's heading, and then we'll go to Calgary, Edmonton.
Well, like Toronto, Vancouver listings are going through the roof. It is
Oh, sorry.
arguably,
Before I apologize, Patrick. Before we go to Vancouver, though, I do want to touch on one last thing in Ontario before we leave Ontario, which is, a lot of people are freaking out about rents, and I'm in the tertiary markets around Toronto, so I'm in Peterborough, I'm in Durham, I'm in Lindsay, I'm in Barrie, I'm in Aurelia, I'm in Hamilton, I'm in those various things. And a lot of people in the tertiary markets, they get skewed by the headlines that see the rents being pulled down in a big way. The rents are not being pulled down everywhere in Ontario, but a huge chunk of the data happens to be in Toronto. And as a result, when these condos hit the rental market, as this graph clearly shows what's happening, this drags down the condo rental prices. And that drags down the averages across the entire province. But that doesn't mean your rental in Peterborough is going to rent for $250 less. You have to do the market research in your particular market. And luckily at Vistor, we have a really good kind of finger on the pulse there. So I'm just letting people know not to get too freaked out. On the flip side, they have to react to market conditions. I have some owners that are just stuck on what they think they can get for a place. I don't care what you think you can get for your rental. I really don't care. It doesn't matter what you think or what I think. What matters is what the market is prepared to give you for it. And whatever that is, take it.
Well, there's a couple things, so we got to talk about, when we look at the Toronto dog crate, 400 or 500 square foot condos. And so there was a time where that made sense. We saw this coming literally 3 or 4 years ago. But having said that, there was some opportunities there, and I think some people did very well. But right now, what's happening is we got to talk about immigration. So in spite of we're shutting down immigration, almost 1 million people, like 900,000 people came into Canada the first quarter of 2025. So what does that mean? Two parts. First off, those people aren't renting Toronto dog crate condos. Some will, but that immigration cohort is not coming in to live in, Toronto proper. That's not going to change that. To your point, what you talk about those other markets, as a Peterborough, for example, or a Barrie or a London, like there's all sorts of other markets where rents have kind of flattened out, but they haven't dropped in a significant way, nor will they, given that immigration still hasn't come down. Having said that, we have to be aware of the fact that things are going to soften. And at some point, immigration, I think they're going to, at some point, some mandate around that. But here's the other issue. Unemployment is ticking up. So immigration's coming in, unemployment is ticking up. There's not enough jobs to go around. That means there's not enough paychecks, which means that rents will soften in many markets. And that is what we're up against right now, is an increasing unemployment rate. But a lot of that, I shouldn't say a lot, some of that unemployment is just based on the fact so many people are coming in, there isn't enough jobs to go around. And that continues to be an issue. But we need it because immigrants drive our economy. It's just such a messy situation. Thank you, federal government.
Patrick, I am loving the unemployment right now. Loving it. It's making hiring so much better. There's such great talent out there. Expectations are better. Such a good time right now from that perspective. As you've mentioned many times on the show, unemployment at 4%, 4.5%, 5% is very difficult to keep growing and keep hiring and keep business going. 7% is nice. I love it.
Yeah. Well, I've said all along that 6.5 and maximum 7. Once we start getting over 7%, we're going to start to feel the effects of that. 6.5, 7, 6.5 has always been my number, with a 7 being at the extreme edge of the kind of the edge of the cliff, if you will, in terms of what happens when unemployment starts to tick up in a meaningful way over that 7% consistent and hangs in there. We start to feel the effects of it. So Vancouver new listings, continue to tick up. And that market, there's, it is not some would say it's a buyer's market, but, interestingly enough, JG, as I'm talking to realtors in the hood, a lot of the new listings are in the condo market, although single family is up there, but sellers aren't coming off their price. So they're just not willing to come off their price yet. So it isn't really a buyer's market. Having said that, for those who are patient and willing to grind it out, put in offers, find that motivated vendor, they're getting deals done. So what do you say about that? Vancouver is going to continue to tick up, but they're not building more. So and forget about the condo market. They're not building more detached, semi-detached. And so this is, right now there's a lot of stuff on the market that's going to get cleaned up. They're not building anymore, which means that you look down in 2, 3, 5 years, what are we going to see? We're going to see a shortage again. That cycle will repeat. So if you're going in now in a quasi slump market, depending on what city you're in, this is where deals happen. And in 5 years, 7 years, 10 years from now, you're going to go, I'm a freaking genius.
I'm a genius. I'm a genius. And then you're going to, let me tell you the second thought that's going to flow past that, Patrick. I'm a genius. Man, this good time's going to last forever. Oh my God, it's party time. Meanwhile, you know what's coming because we opened the show with that. Good. You always think good times are going to last forever. You always think bad times are going to last forever. And on both accounts, you are dead wrong.
You're dead wrong.
Calgary, Edmonton, Patrick, take us through it.
Well, if you look at the Calgary, Edmonton, if there's a couple charts there where you can actually see the comparison. I was really happy to come across these charts again because you start to see how Edmonton mirrors Calgary. So the point of it is Calgary's gotten soft. They're just kind of going into the early slump cycle, which doesn't mean, by the way, that it's going to crash. Slump does not translate to crash. Slump just means things are softening and things will remain soft. We don't know how long, but I'm guessing the next probably 18 months, we're going to see things in Calgary get a little softer, not crash, but get a little bit softer. Edmonton will follow suit. There's no question about that. That's just kind of how that Alberta market has always played out. And it's pretty much an exact mirror in many ways. It's just it's a lag. So as we see Calgary now softening, we'll see Edmonton, and what I said before, you're going to see Edmonton in a year from now start to soften more, and it's going to be noticeable, and we'll go into that slump cycle. We're just coming out of the boom cycle in Edmonton, based on the data.
These charts, Patrick, are definitely fascinating, and you can see how they really is. I mean, it really is in lockstep, and this makes predicting the market even that much easier.
Well, but Calgary for sure.
Yeah, it's fascinating to see for sure. And these are great charts to show people what's happening and where the market's going. So interesting. So you're going to sell more in Edmonton. Let's wrap this up by talking about your plans in Edmonton. You're going to sell more? Is there a fire sale on Patrick Francie properties or what?
Yeah, I'm taking everything out of Edmonton. And so slowly but surely, I'm just kind of picking my spots and picking my properties. And but I'm going to move my money around. I'm going to move it around. So it's just not going to be in Edmonton. That's my strategy. Maybe I'm full of shit.
The good news is you're playing with your own money, so you're going to find out.
That's it. I'm going to find out.
All right, Patrick. So it sounds like there's a Patrick Francie property fire sale going on. You're selling your stuff in Edmonton. What are you going to do after that? I mean, once you've liquidated a couple more properties, what are you going to do with it all?
Well, I've said hard assets. We have to just know the value of fiat currency. It's being devalued, decoupled. That's just the way it's happening. Whether we can see it or acknowledge it or understand it, it's what's happening. So we need to own our hard assets. Hard assets being real estate is one of them. In my case, hey, JG, when did I start telling you to buy gold? Was it 7 years ago, 6 years ago?
It was a solid 5 years ago for sure.
It was for sure 5 years ago. And anyways, and what did I say? Buy a little bit of gold, buy a little bit of silver. And by the way, just to rub it in, when I started talking to you about it, gold was like 17, no, that's US. So we'll say it was 22 grand. We'll say about $2,000 an ounce Canadian. Do you know what it is today?
4,200. 4,200.
4,600. And when I started telling you to buy a little bit of silver, it was 32 Canadian dollars per ounce. Today, it's 50. So what does that mean? I don't look at, and I own some precious metals. I've said that many times, and I own some Bitcoin. So my precious metals, I've said all along, I don't look at it as an investment. I don't. It's just money in a different form. I'm taking fiat currency, which is losing all of its value, and I'm exchanging it for some precious metals, which is hard asset, real money. That's it. So I haven't lost any value in my fiat currency. As a matter of fact, I've gained. I've stayed ahead of the curve by owning a little bit of precious metals. I own a little bit of Bitcoin, another hard asset. It's just a distribution. So these aren't big parts of my portfolio overall, but they are a meaningful part of it. Not significant, but it matters. And, in hindsight, I wish I would have bought more.
Of course. Okay. Of course. That's great. And now you're going to have a precious metal expert on one of your upcoming podcasts or stages, right?
Andy Schechtman, he's coming in and he's not here to pitch precious metals. He'll give you a good argument of why you should own precious metals. He is the CEO and I think he's the founding with his father of Miles Franklin. And what they do is they produce gold, silver, precious metals. That's the game that he's been playing for 40 years. But the big thing that I want from Andy is to explain and give people insights, literally, why you need to get out of fiat currency. And he's a US guy, but he'll speak to what's going on in Canada, and what happens in the US impacts Canada. And I can't stress enough, Andy's going to come in and do probably a way better job of explaining the devaluation, the decoupling of fiat currency globally, by the way, and why in his world precious metals make such a big difference. He'll also speak to real estate. Now he's a bit of a real estate fan, but he looks at real estate in a different kind of light than he does with the precious metals, because that's what he does. And JG, on the next episode, we're talking about P. Diddy. How's that?
Let's do it. Well, there you have it, folks. We covered drama. We covered Trump. We covered Elon. We covered AI. We covered job loss. We covered all kinds of things. And we got into some real estate practicality, strategies, tips, tricks, what you're doing with your real estate, what I'm doing with the real estate. It's been a great episode, Patrick. Fantastic job.
We crushed it. Good job, JG. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.